Looking at a consolidated balance sheet in particular, we're looking at the stockholders, the equity section of the balance sheet. So what is in stockholders equity? What are typical things you're going to see in stockholders equity? We're going to cover common stock that's issued at par. We're going to cover common stock, the additional paid-in capital, treasury stock, retained earnings, and dividends. Let's dive into this. Before we go into the categories that we just outlined, I want to go over this concept of shares authorized, shares issued, and shares outstanding. Shares meaning stock. This is going to be stock in a C corporation, S corporation. Shares authorized means these are the amount of shares the corporation can ultimately issue. So they can ultimately issue 10,000 shares. That's the maximum amount of shares that can be out there or owned by stockholders. Now, that can be adjusted. You can go to your articles of incorporation and change that. But from the beginning, you have to determine how many shares you want to authorize. Now, the next level down is shares issued. Out of that bucket of shares that you have authorized, how many have you actually issued to shareholders? And in this situation, we've issued 2,000 shares. That means there was a stockholder that currently owns or has owned those shares of stock. The corporation can still issue 8,000 more shares without changing its articles of incorporation. And then the next level down from there is outstanding. How many shares are currently outstanding? How many shares are actually owned by shareholders? And that is the difference between authorized, issued, and outstanding. A lot of times you're going to see issued and outstanding be the exact same number. But we're going to go over why that number can be different when you're looking at a balance sheet of a corporation. So let's dive into our first category, which is common stock issued at par value. Okay, this is our 3,000 account. This is our first line item. Common stock issued at par value. With shares of stock, you have to establish a par value, which is basically the minimum value that stock can be sold or repurchased for. In this instance, we have a $100 par value. These shares of stock cannot go below or cannot be sold or repurchased for less than $100. In our scenario here, we've done 2 share offerings. One in 2009, we issued 1,000 shares at $100 par value. Par value doesn't necessarily mean that we sold it at $100. It just means it cannot be sold. Those shares of stock cannot be sold for less than $100. So I'll explain that in our next category, additional paid in, but just follow me through the par value. So we're going to debit $100,000 of cash for the par value portion of the common stock and credit common stock par value. Now, if we sold it for more than $100 a share, we'll go over that in 1 second. In 2023, we issued 1,000 more shares at the par value, $100. So we're going to recognize that same journal entry again in 2023. We're going to debit cash of $100,000 for the par value portion of the stock we issued, and we're going to credit common stock par value. So let's transition over to additional paid-in capital because that's the other part of this equation when you're issuing shares, especially when you're issuing shares for more than par value, which is ultimately always going to be the case. I'm going to leave 3,000 common stock par value there so you can see the full situation that's happening here. Anything over the par value is going to get recorded to additional paid-in capital. For example, in our 3,100 common stock additional paid-in capital account in 2009, when we issued the 1,000 shares, the share price was actually $150, which was $50 over the par value. So the total amount we raised in 2009 when we issued those shares was $150,000. When we record that journal entry, but we're going to break down the share issuance between par value and additional paid-in capital. So the par value was $100 a share. So that's that $100,000 we went over before. The difference, the $50 over the par value price in our share price that we offered these shares for is $50,000, the $50 times 1,000 shares. Or you can think about it, we raised $100,000 of that was par value, 50,000 of that is additional paid-in capital. So when we record that entry, we're going to debit the cash for $150,000. We're going to credit par value stock for $100,000, and then we're going to credit additional paid-in capital for the difference, the 50,000. So that's how you break down when you issue shares between par value and additional paid in capital. So let's just run that back for 2023. We issued 1,000 shares again. The par value stays the same. It does not change. It's $100 a share. The par value is $100,000. But the stock price we sold these shares for was $225, $125 over the par value. So still issuing 1,000 shares. We raised $225,000 in this share issuance. The par value still $100,000 for 1,000 shares, but the additional paid in capital now is $125,000, the difference between the par value. The share price went up, we raised more money, and the difference is put in additional paid in capital. So my journal entry in this situation is going to be debit cash, credit common stock par value $100,000, credit additional paid in capital for $125,000. So as the price goes up when you're issuing shares, the more you're going to have an additional paid in capital. Par value of stock is going to remain the same. Par value can be wildly different between corporations. It could be a penny, it could be fractions of a penny, it could be $10,000. It really depends what you set up when you set up the articles of incorporation. So that's par value tied into additional paid in capital when you're issuing shares. And just to recap, these are shares that have been issued. You've taken it out of your authorized bucket, and as long as you haven't bought them back, the corporation has not bought them back, they will be outstanding as well. So let's see why in the scenario here we have less outstanding than we have issued. Going back to our balance sheet, we've got common stock par value, common stock additional paid in capital, and now we're going to introduce this treasury stock concept. And I'm using the cost method. In our example here, the corporation on January 1st, 2024, repurchased 800 shares at a share price of $250. Going back to the shares authorized, shares issued, and shares outstanding, that's why we have a difference here, because in 2024, we took 800 shares out of circulation. The corporation bought those back. I also want to recommend watching the non-current liabilities video that I have here, because I give an example of a shareholder note payable. So in this comprehensive example, the corporation has bought back 800 shares at $250 a share for a total price of $200,000. And we have issued the shareholder a note, John McClain in this situation, for $200,000. We didn't give him cash right away. We gave him a note. I just want to tie those in together. I highly recommend watching the non-current liabilities video. I will link that in the description so you could check that out after watching this. So going back to treasury stock, as I said before, John McClain, we've taken 800 shares out of circulation. We only have 1,200 shares outstanding. We are going to debit treasury stock, 3,200. On our balance sheet here, 3,200. And you can either, depending on how you finance it or how you pay for these, you can either credit cash, if you give the cash to John McClain in this situation. But if I tie it into my non-current liabilities video, we actually gave John McClain a note payable. He doesn't own those shares anymore. He now has for him, it's a note receivable. He's going to be collecting that money in interest. To the corporation, it's a note payable. We owe John McClain that $200,000 plus 8% interest for buying those shares back from him. Now, our fourth line item here and our fifth line item here, retained earnings and dividends, are going to be tied in together. I'm going to start with retained earnings, and I'll explain why I have dividends out there, because some of you might look at that and be like, why does he have dividends out there? Okay, 3,300 is our GL account for retained earnings. Retained earnings is the cumulative net income that this company has retained over its life, less any dividends that have been paid out. So every year, net income gets closed out from the income statement onto the balance sheet in this concept called retained earnings. It's basically the profits the company has accumulated and maintained on its books and records since it started. And the other aspect that will lower that, assuming you have net income every year, it's going to keep going up and up and up. Your retained earnings is just going to get bigger. What lowers that is paying out dividends. But you will ultimately close dividends into retained earnings. So Retained earnings, when you're closing your books, staying on that topic, you are going to, when you close out the income statement, you run your year-end procedures, it's going to close all your income statement accounts. It's going to debit the revenues, it's going to credit the expenses, and the other side of that entry, which ultimately is net income, is going to be retained earnings. That's $3,300. A lot of times your software does this for you automatically when you're doing the year-end close. I can't think of an example where I've actually done those journal entries in a software or accounting software. But if you had to do it manually, you wanted to, when you're closing out your income statement, because income statement is just going to be on a 12-month basis, you would debit your revenues, credit your expenses, plug the net to make that journal entry balance would be retained earnings. That is what your software is doing when you're closing out years to the balance sheet. In our scenario here, 3,300 retained earnings, our beginning balance was negative $140,000. We actually had a cumulative loss in this business. Now, 2024 was a great year. We almost had $1.2 million of net income. So when we're closing out the 2024 year, we're going to take our starting balance of negative $140,000 of retained earnings, debit balance, and we are going to credit $3,300 for the net income related to 2024 to ultimately bring that cumulative balance up to $1,050,000 of retained earnings in this corporation. Now, jumping down to our category number 5, dividends are going to get closed into retained earnings. I just wanted to highlight during the year, when you have dividends, you might be just having a subcategory or a GL account to record the dividends to ultimately close into retained earnings. That's what I've done. I have found that helpful for tax preparation. So in this example here, December 5th, 2024, a $100,000 dividend was declared. I'm recognizing it in 3,400. But if I jump back to retained earnings, because I can't carry it into the next year, you close the dividend into retained earnings. So in this situation, I'm going to debit retained earnings. And I'm going to credit dividend, my 3,400 account. And what that will ultimately do, I just want to give you an example of how that looks. So total retained earnings, $1,050,000 right now. That's our ending retained earnings balance, which we roll in the net income from 2024. And when we close out the dividend to retained earnings, since retained earnings is a credit balance, so dividend here, that is going to reduce our retained earnings. So ultimately, when I do the year-end close, I'm not going to do this in this full balance sheet here. Ultimately, the retained earnings will be $950,000 once I close out this dividend that was declared. And the balance sheet will ultimately reflect 0 for the dividend, and it will reflect $950 for retained earnings. But I just wanted to go over that so you can see how that happens on the balance sheet and when you what happens when you do a year-end close, when you close out dividends to retained earnings. All right, that's equity on the balance sheet. It can be complicated. It can be confusing. I actually think it's one of the harder sections of the balance sheet compared to assets and liabilities. I hope this was helpful. I hope you got something out of this, and I will see you in the next video. Take care and goodbye.